Do you think we should ratchet up our GDP estimates given the outcomes over the weekend?
Not yet, Brian. The economy, based on production, the ISM figures, what probably is a slower pace of employment, suggests the economy is not growing at 3, but something 2% or possibly less. If the trade negotiations continue and there's not a full imposition of tariffs, and this is more important, Brian, and the Fed cuts interest rates, the back half of the year will look better. A lot depends on the Fed. And what most investors miss, Brian, is the fact the Fed has raised interest rates in this cycle significantly more than what many believe. And that, to me, is what really is in the midst of slowing the economy. It's much less about the trade.
Yeah, but I wonder, Joe, does what happened over the weekend, does the potential resolution of a G20 or the trade fight, does that change the Fed's thinking? Or, as we talked about earlier in the show, is the Fed so deep in that hole that it's not going to be able to change what it wants, whatever the data happens and whatever the outcome of the trade talks may be?
Deep in the hole, Brian, in the sense that they're definitely doing 25 basis points. This truce, if you will, perhaps takes the probability of 50 basis points out, lowers that probability. However, if the data over the next few weeks turns out to be much weaker than expected and there is more trade rumbling, I mean, this trade issue is not settled by any means, then the Fed will move more aggressively. So the trade helps. But again, it really depends to me on what the Fed does. And proof of that, Brian, is if you look at the housing market, that's actually the softest part of the economy. That's a reflection of the significant rise in rates that occurred over last year, which now rates have fallen, so refi activity in housing is looking maybe a little bit better. But for that to continue, the Fed needs to validate market expectations. So in terms of the rate trajectory, I still see the Fed cutting 75 basis points and don't believe the trade truce, if you will, the trade thaw is going to change that.
Yeah, maybe we're overstating that as well, because I know it gets all the headlines. The president has a way of doing that, Joe. 74 whatever percent of the economy is simply consumer spending. Mom, pa at home going out, deciding to buy a house, buy a car, buy a piece of furniture. Do you believe they are being impacted by the headlines that they see, or are they simply going on with their lives? We still have low unemployment. We've got some wage growth, and the U.S. economy will continue to do well, at least not make a recession in the next 12 to 18 months.
Brian, they're probably more impacted by what's happening with oil and gas prices and that Philadelphia refinery going down. I don't really believe the American people are that focused at all on the trade. The impact has been very minor at this point. It's more of fear of what happens to global supply chains and will be a worst-case scenario of an all-out trade war, which I would say the probability of that is extraordinarily low. So it comes back to employment, as you highlighted. Gas prices, this is the driving season. People are on the road a lot. They want to pay lower prices. Consumer confidence is high, and the job market still looks very good. Of course, it's lagging. So the consumer will do okay, Brian. It's really more about exports, global economy, and what happens with U.S. CapEx, which has been soft.
Very quickly, what could be your surprise shock in the second half of the year?
Surprise shock at this point would be faster than expected growth and more than expected Fed easing. Sort of a combination of two outlier scenarios. You get more from the Fed, but then growth turns out to be faster, and the Fed's sitting here next year not knowing what to do in an election year.